Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. So here's the latest this morning. The president leaning into the campaign promises he's kept as new polling shows a dip in his approval rating. And Libby Cantrill of PIMCO joins us now for more. Libby, good morning.
Good morning.
Is there a tell in Texas?
I mean, I think for good reason, the GOP is paying attention to it. Obviously, this is a red state, a ruby red Senate district, the state Senate district that flipped to Democrats, went from 31, kind of a swing of 31 points from the 2024 election. It is still early days, but there are other metrics in addition to these off-cycle elections that I think are warning signs for Republicans. The approval rating is one of them. The generic ballot, sort of generally, how does the population feel about Democrats over Republicans? They're favoring Democrats right now by 5 points on average. And then enthusiasm. Democrats seem to be more enthusiastic. Those are all, we have a little mini midterm election model that we built at PIMCO, and those all are statistically significant. So in addition to Texas, the data is also pointing to signs that, like history, the Republicans are probably poised to lose seats in November. However, it is really early days. It's still only, even though it was a very long January, it's still 9 months away, so a lot, as we know.
A Republican strategist said the same thing to me last night. Anne-Marie, it's early days. Don't look at Texas. We have till November. We have the one big, beautiful bill coming out. What else is the president going to be focused on before November?
Well, I think Republicans do want show, not tell, right? President Trump wants to tell folks, and obviously, and this is sort of what Joe Biden did as well. Understandably, he's proud of the things that he's accomplished in 2025. I think Republicans on the Hill, though, do want to pivot to showing, and they're hoping that these very large refunds that the households are going to be getting, the fact that withholding tables are decreased, and so people are getting bigger paychecks, all of this will, sort of buoy sentiment. Now, what President Trump has talked about, the sort of affordability agenda, and I think, again, Republicans want him to pivot from immigration back to the affordability agenda, things like capping credit cards, preventing institutional investors from buying single-family homes. Those things all need Congress, and I don't think we're going to see Congress do anything, honestly, on the fiscal side.
It's weird because Wall Street acts like some of this is done.
Yeah, and I think, I'm not sure. I mean, so the president, and it might frustrate him, understandably, I think it'll frustrate other presidents as well. He just only has limited authority in terms of moving the needle, right? The executive branch executes existing law. It is the Congress that creates the laws, and there is no law that gives the president authority to do either of those things. What he can do, Anne-Marie, which we've talked about before, is he can direct Fannie and Freddie to buy more agency mortgage-backed securities. They have been doing that for several months in the end of 2025. We think they will continue to lean into that. I think the read-through for investors, not only is that good for sort of mortgage spreads, mortgage rates, and potentially helping the economy at least, marginally, it also does decrease the chances that the GSEs go public. I think the president understands he actually would much rather control the GSEs than to issue them to the public.
Well, how much more do you see them actually buying? I mean, how much could this be accelerated and become a main story, particularly at the long end of the yield curve?
Yeah, so I mean, it's a good question. Right now, FHFA and Treasury have capped how much the GSEs can hold on their balance sheets to $450 billion collectively between Fannie and Freddie. Right now, they have about $250 billion as of last filing, so they can still go up. I mean, the president has directed that $200 billion gap to be filled. Now, interestingly, that $450 billion, that is not a statutory limit, meaning the Congress doesn't have to get involved. FHFA and Treasury, FHFA, the regulator of Fannie and Freddie, can simply change that. So there's actually, I think, a lot of runway here. If you go back to the financial crisis, Fannie and Freddie owned up to $1.5 trillion of mortgages. So are they going to go back there? Probably not. But, there is still more runway. Now, I think the question, though, is on Warsh and the balance, the Fed chair nominee, Warsh on the balance sheet, because, of course, they're letting kind of mortgages run off, effectively selling mortgages. And, of course, the other side of the administration is buying mortgages to bring down rates. right. So we'll see. There's a little bit of tension there, as there always is, between the fiscal policymakers and the monetary policymakers. We'll sort of see if he's asked that in his confirmation hearing.
I'm really glad that we haven't talked about a government shutdown so far today. Evidently it ended, and now we're fine, except that
It's
potentially not so much in about 9 days when TSA might get defunded and then we won't be able to fly. And I'm just wondering, how likely is that TSA and the Coast Guard are going to be what gets defunded in 9 days, and so that all of a sudden the airports are going to be absolutely terrific, or in a terrible way, in the next couple of weeks?
Is this bothering you? Oh, Lisa, no. I understand. Obviously, this is one of the ways that people consume government services, right, is through the airports. I think happily we are not going to be talking about a macro impactful shutdown until potentially September, when Congress then has to fund the FY27 bill. I think that's unlikely, though we see a shutdown. Usually folks don't like to shut down the government right before the midterms. But you're right that this one thing that has not been funded, funding for DHS, does include TSA. There's obviously this negotiation going on around ICE limitations and what have you. We'll sort of see how that plays out. But we could see that shut down. I think more likely, though, you might just see another CR to sort of build time. I think that, shutdowns do not play well politically on either side of the aisle. And I think both parties have a vested interest in not seeing the government shutdown.
Stay with us. More Bloomberg surveillance coming up after this. South Korea's top diplomat meeting with Secretary of State Marco Rubio as the country races to avoid a tariff hike. Jean Seroka, the executive director of the Port of Los Angeles, writing, "Tariffs continue to keep everyone on edge. I expect more uncertainty ahead on the trade front." Jean joins us now for more. Jean, welcome to New York. Good morning.
Good to see you, John.
It's good to see you, sir. Let's get into the numbers. Talk about tough comps. I think that's an understatement to say that you've got tough comps relative to last year. How much have things slowed down?
January, over 800,000 container units, off by a little bit more than 10%. February looks to be about the same. We've got a mid-quarter Lunar New Year, so March will see a traditional drop-off. If you look at Q1 versus last year, we'll probably be down in double-digit fashion.
How much is this a reflection of consumers not buying, and how much is this a reflection of a lot of different industries not wanting to import because of the tariffs?
Lisa, probably a combination of both, and here's why. Last year, and even going back to the campaign trail, as we've discussed, you saw a lot of run-up to try to build inventories ahead of tariffs and work unit prices down. Secondly, while retailers are doing okay, holiday sales not bad, Matt Shea says we crossed $1 trillion, according to the National Retail Federation, that's also inflation-induced. So the number of units moving at the retail level, a little bit lower, prices have gone up.
How much has there been a complete shift in terms of where things are being sourced that do come to the port? I'm just curious if there is sort of a sense of favoring, say, places in South America over, say, Southeast Asia. Have you seen that shift in a material way?
Yeah, it's noticeable, and companies are still looking. CEOs and executives are telling me that their staff is spending a lot more time both on simulation of what would happen next based on policy, where do I source from, how do I get contracts in place, and just trying to keep up with all this information. So for us, China was 60% of our portfolio back in 2018. This year it'll drop below 40%, yet we're still growing because we've been chasing the freight. But trying to keep your eye on what's next is going to be very interesting. Trade deal with India yesterday, maybe some possibilities there.
Well, this is interesting because I didn't get a direct answer from Ambassador Greer in Davos about this. The transshipment, how do you track it? Because China is still sending to the United States, just not directly from Beijing. There is a middle point.
Yeah. A couple things. Traditionally, supply chains in Asia work country to country. So the buttons and plackets on a shirt made in China go down to Vietnam. You make the whole shirt, sell it to Macy's here on 34th Street. Some bad actors out there are trying to circumvent tariffs, go to lower cost countries by transshipping. But China, as announced in the 15th five-year plan, is not only exporting goods, they're now manufacturing expertise exporters as well. So they're investing in plants along the Pacific Rim and other locations around the world.
Do you think this administration will go after that?
Yeah, probably so.
How challenging is that?
It's really challenging because it's tough to get hard data on where the supply chain starts and ends.
Who's funding it? Yeah.
And who's funding it.
We've talked lots with you about how much you improved systems and processing through the pandemic. How much have things slowed down because of the tariffs? Can you give us an idea of what that looks like now relative to where it was the year before?
Well, historically, compared to the numbers of containers we're moving right now, we look pretty decent. But it's been super choppy from COVID to a little bit of downturn based on high inventories and then all this tariff buildup. It just looks different. But last year was our third busiest on record in 118 years, and we didn't have one ship backed up. We're doing things a little bit smarter, working together, and information technology plays a huge role here, John.
That's super impressive. We can still see in the data, though, that there's still problems. ISM manufacturing came out in the last couple of days. And if you go through the commentary, Gene, allow me just to go through the commentary here. Trade tariff uncertainty is creating volatility in the supply chain. It's making long-term planning pointless. This comes from a range of industries within manufacturing. There continues to be uncertainty and added costs through our global operations. Lisa, just going through the details, it was a great number, by the way, decent print, but you go through the details on the commentary coming from various industries. It's not good. It's not good reading at all.
Well, it creates this level of uncertainty. And when you talk to different CEOs, they say, we didn't price in a lot of the tariffs last year because we had inventories that we were pushing through. We don't have those inventories anymore. So now we have to pass along the price increases. And how can they do that at a time where the consumer is looking for value?
So last year we talked about this concept, this phrase that Jim Zelter of Apollo mentioned, and it was macro paralysis, that for a lot of companies, they were just sat still. They couldn't make decisions, didn't know what to do. Do you see any of that?
I do. Yeah, we talked some time ago about people hitting the pause button, and their finger is still on it. Hiring is flat, new jobs non-existent, and realistically speaking, companies are not looking at longer-term horizons for planning purposes, and capital investment also very soft.
Then how do you plan for that?
We have to invest through budget cycles, economic cycles, and even election cycles. We've got about $10 billion worth of projects on the capital side right now. New terminals for the first time in a generation. We need a new bridge crossing onto Terminal Island and outlining more rail capacity as well as road connectors to keep this cargo flowing. We'll see this. It'll be ups and downs, but long-term growth will take place.
If companies don't have inventory anymore, and they don't want to build too much inventory because they don't know how things are going to change, how much are people looking for much faster shipments and smaller shipments each time?
That's exactly what's focusing right now. And what we saw last year, when the trade policy was softened and tariffs came down during negotiations, importers had windows of opportunity to get their cargo here. And the fastest way was through the Southern California Gateway. So while overall imports were down in the country, we were up simply because of that certainty and the fast pace that we could get cargo from Asia into the country.
Stay with us. More Bloomberg surveillance coming up after this. Downside surprise, 22K. The expected number in our survey, 45,000. With us around the table, James Egelhof of BNP Paribas. James, good to see you.
Great to be back. Thank you.
We've seen some signs, not here, but elsewhere, that the labour market was firming up a bit coming into the new year. Would you put more weight on that than this?
Look, we think the economy is at a great place this year, and we're very optimistic about the outlook. We're looking for very strong growth that's driven by stimulative fiscal policy, stimulative monetary policy, stimulative markets, and the early signs of AI beginning to impact the economy. We think there's a likelihood that some of that is going to slosh into the labour market and support what we think has already been a pretty resilient.
You've got no cuts for 26.
Absolutely not.
Just explain that for us.
We think the Fed is going to react to the data, that it's going to follow the economic outlook and its standard policy framework, regardless of who leads it over the course of the year. So we think that Powell, I think, has delivered the easing he wants to deliver. We had earlier thought there might be room for one last one, but the data has just held up just so well that we've recently taken that out. Beyond that, we think the data will tell the story, and that the story of a strong economy and with a stable labor market and with inflation that's a bit higher than what we think the Fed is looking for.
Well, we're not going to get the data on Friday, so we're not going to have the data that actually proves that out yet. The data that we are getting, this ADP number of 22,000, I mean, it's pretty low. How do you look at this and explain to people this is actually very good?
Well, this is the debate at the Fed, and we saw Governor Waller dissent saying, look, zero jobs growth over last year after we see expected revisions in his estimation, that's not a healthy labor market. And you have others, including Chair Powell, saying, look, immigration policy has changed a lot. There are a lot fewer people coming to the country. A lot of people have left. This may well be a full employment pace of job gains. So our view is that the pace we'll see over the coming year is something on the lines of 50K. So this is a little bit low, the one that we just saw from ADP. But that ultimately is the pace that, in our view, close to that pace, that maintains the labor market at this current level of unemployment.
One of the reasons why a number of people have priced in at least 2 rate cuts for this year is not because they think the economy is going to fall off a cliff, but because they believe that any kind of growth is going to come with disinflation. We saw Pepsi, for example, cutting prices by 10 to 15% in response to some of their efficiencies to try to increase their customer volume. How much do you see this as likely creating a good backdrop for the Fed to be cutting? I mean, because if you don't see any cuts, you don't buy that disinflation story. Is that right?
Yeah, our view is that the AI boom is coming and we're going to see a boost in productivity, but that will also come with it a cyclical boom as well. And part of that is because of the neutral rate rising over time, and part of that is because of the existing level of stimulus that we're seeing from fiscal and monetary policy and from financial markets. So in addition to seeing the boost, the disinflationary boost to growth that you're referring to, we'll see a cyclical boost as well. This is a similar story to the 90s where the Greenspan is widely heralded for not hiking during that period. It wasn't that he cut into that. It was that he delayed hikes to allow the productivity boom to play out. And we think that that's a likely prospect ahead, is that the Fed will stand pat while it sees strong growth and while it sees some residual inflation pressure.
Well, you seeing the AI boom and productivity being inflationary or disinflationary?
See, productivity on its own being disinflationary, but it will come with more. So we'll see some growth from AI, and then we'll see even more growth. We think we're set up for a very strong year of growth, and that will come with it labor market strength and with a bit more inflation.
But when it comes to the AI build-out, data centers, et cetera, that is, do you think, inflationary? The electricity needed, the cost of building?
We think it's a moderate impact on the inflationary outlook. Tech CapEx as a contribution to GDP isn't historically that high. It's just become a bit more concentrated. So we think that that's ultimately a fairly modest impact on our growth and our inflation forecast. What we think has mattered more has been the overall booming business sentiment that has come from AI. We saw ISM earlier this week as a blowout. We think that part of that is optimism from AI that's filtering through to the rest of the economy and supporting activity. That has a cyclical component to it, and we think that will help drive growth, help drive the labor market this year.
I'm intrigued by your read on Kevin Walsh, so let's develop that a little bit more. Governor Myron said this week: I'm probably looking for a little bit more than a point of interest rate cuts over the course of the year. Why would Chair Walsh be that much different to Governor Myron?
So when I think about this, I often go back to James Carville's comment from the 90s, that when he's reincarnated, he wants to come back as the bond market because he can intimidate everybody. Ultimately, we think Fed chairs face fairly strong incentives to deliver pro-growth, pro-market outcomes. Kevin Walsh is well known for being a very well-networked person among financial circles, and we think he will follow the same asset price signals as other Fed chairs do. And that will leave him, in our view, following a fairly standard reaction function. We think he will want to do that, because that is what achieves the best economic result. And we think he will face pressure from the rest of the FOMC to do that as well.
At least he's not convinced. I can just see out the corner of my eye that Brandon wasn't convinced.
Well, no, I just think that if he talks to people in the market, there are a lot of people who actually agree with the Fed potentially cutting rates at least 2 times. I mean, the Wall Street isn't exactly unified in what they think. And more people who come on the show think that the Fed should cut rates a couple more times this year than not. So I guess that's the skepticism that I have.
Look, we're not hawkish, we're bullish. So we think the economy is going to perform very well this year.
Making, James.
Well, I just got to tell you our forecast. So look, we think the economy is just going to do a bit better. We think that people have been really reluctant to give this economy credit for how strong it is, for how strong the cyclical impulse is. I think the Fed is pulling teeth sometimes, but they've upgraded their forecast of growth to solid. We think that growth is going to be strong this year, and that's going to have implications for the rate outlook.
So you don't buy, though, that growth can be disinflationary, that you can run stronger but not hotter, right? So you basically are rejecting that idea. Where is that inflation going to come from if it's not coming from housing and it's not coming from Lay's potato chips?
Look, you can have disinflationary growth. We just don't think we're going to. We think the economy is going to do so well that it's going to sustain inflation. We think there's a bit more to run on tariff pass-through. I think that's not quite done. We think we've got another year of that at least. And we think that the services market is going to hold up well. And the data we'll see today from ISM services will tell us some of that story in the absence of any other data this week. We're above consensus for that print. We were above consensus for ISM manufacturing, which I noted was a blowout. So we're looking for another strong print there. And I think as we see the data over the coming months, you will get the sense for how well the economy is performing and the implications that has for a modest uptick in inflation.
James, I'm also skeptical of Warsh not delivering any cuts, and not just because, to Lisa's point, everyone comes on here and says at least maybe 2 we're going to get this year. How did he get the job? How did he convince Trump to put him in that seat if he's not going to deliver at least minimum 1 cut this year?
Well, we think that the important thing here is the relationship with the White House, that Kevin Warsh has a long-standing personal, family, professional relationship with President Trump. And we think that will be helpful to him in the seat in establishing a more normal relationship between the Fed and the White House. What we've seen over the past year is not sustainable. It's not consistent with Fed independence. That Kevin Warsh turns a new page and should, in our view, be able to run monetary policy with greater independence because he will have that trust with the White House. We think he will start the conversation with the balance sheet and talking about how over time to reduce the balance sheet. That's where he's made his name over the past few years. We think there's a deal to be made at the Fed on reducing the balance sheet over time. And the watchword for us will be whether Kevin Warsh refers to the words gradual and predictable. Ultimately, we think the market would tolerate a smaller Fed balance sheet so long as it's not a surprise and it comes in a well-communicated way. The market is much less excited about big shocks. And so a big taper tantrum we think would be risk off, but a gradual and predictable transition of the Fed's regime to a smaller balance sheet we think would be well taken.
That's certainly the interpretation of a lot of people in precious metals going into the weekend after that announcement. Just quickly, what's your GDP number for this year?
We're in the mid-2s.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.